Welcome. You're listening to Mortgage Investing 101, the show where we discuss high yield real estate mortgage backed investment opportunities. I'm Edward Brown, your host, and I'm proud to introduce my co host, Mark Hahn, president of Pacific Private Money, one of the fastest growing private mortgage investment firms in Northern California. Our goal on this show is to provide information and to increase your awareness of these important alternative investment strategies where you can earn, all right, you're sitting down, get this, secured high yields using your savings or IRA accounts, and annual yields of 8% and more are not uncommon using the strategies we're going to discuss in today's show.
I think most of them are probably sitting down, but just keep your hands on the wheel.
Okay, exactly.
If you're driving.
And if you like what you hear today, please call Pacific Private Money at 415-883-2150 for more information, or go to pacificprivatemoney.com. Now, for fun, we're also going to have trivia contest where before each commercial break, we're going to ask a trivia question, and the first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. And the vacations are not sponsored by the radio station, but they are sponsored by Lighthouse Resort and Marina, which is located 1 hour northeast of San Francisco. Now, the vacations are free. Lighthouse is only requesting a $75 house cleaning fee. Check them out at lighthouse4fun.com. Today's trivia theme is number one hits of the 1980s.
Music. That'll be good.
Music, that is.
Music hits.
Okay, now, Mark, we've been doing this show for a few months, and your fund is growing very rapidly. Why is that? And give the audience a little background.
Sure. Well, you're listening to Mortgage Investing 101, and we created this show to talk about in great detail exactly what mortgage investing is and how you can earn exceptionally high yields that are secured by real estate, secured by notes recorded against real estate. And we've talked in past shows about the Pacific Private Money Fund, which is really the fund that we launched in early 2013, and we've in fact just collected another new investor this week for $100,000. Was happy to collect that check, and I think the reason it's growing, well, first of all, we're 10 years or more into an effectively zero interest rate environment for savings. So we're not talking about the stock market right now, because the stock market is doing well. I mean, if you invested your monies at the beginning of 2013, which most people, of course, did not, but you're really happy right now.
Sure.
Stocks are up. What we were talking about last week, was it 25% or just?
It was pretty high. Let me back up for just a minute, because what I wanted to let the audience know is that a lot of your investors are fairly sophisticated, which I think lends itself to showing how much due diligence they do and how decent your fund is. We're not talking about just little old ladies who are investing. Of course, if they qualify, they can invest in it. But you have real estate attorneys who have looked over your documents and decided, you know what, you're a decent company, you've got good due diligence here, and you're providing a fair rate of return.
We have two real estate attorneys in the fund. We've got a financial planner in the fund. I think it's, and these guys, like you said, we do specialize, I think, well, first of all, we specialize in making loans to sophisticated real estate investors, and our investors in the fund, where we make those loans, are also fairly sophisticated. Part of that has to do, I think, with our team. Like, personally, I have 30 years experience in real estate, so it's the only career I've ever had. And mostly as a principal, developing real estate and borrowing a lot of money, so I'm very, very familiar with the lending process. And so we started Pacific Private Money in 2008 when we saw that banks pulled out of the lending market after the subprime meltdown, not to homeowners. Now, of course, that they've been making consumer home loans forever. In fact, that's how they made all their money in the last 5 years. But what they stopped making is loans to real estate investors who were buying investment property. And so our company was launched in 2008 to provide leverage and collateral and capital to the real estate investment community, the contractors, the rehabbers, the real estate investors who were buying foreclosure property. And what we found is that it got so popular that it made sense for us to launch a mortgage pool fund, which we did in early 2013. And so we've been very successful in attracting sophisticated, experienced capital because we've been able to provide a very lucrative return. In fact, we just sent out our fourth quarter return. It was for the 6 months ending 12/31. It is just under 8.6% on a simple interest basis.
Excellent. And one thing I wanted to point out too is that even though you have a lot of sophisticated investors, you don't necessarily have to be a rocket scientist to invest. Because when I'm here, I'm pretending I'm the audience for a minute, listening to this and thinking, oh, if they're sophisticated investors, well, gee, if I'm not sophisticated, it's probably not for me. But that's not the case, because this is actually a fairly simple investment.
It's really simple. And so, again, we're talking about mortgage investing, and we're talking specifically about a type of mortgage investing, which is investing in a mortgage pool fund. And again, we launched the fund in early 2013, and we made it really simple to invest. In fact, most funds are set up to be easy to invest, but we went a little even further in that I wanted to make sure that my trust deed investors, the ones that used to invest in individual notes and are now investing in my mortgage pool fund, I wanted to make sure that they understood that I was highly motivated to make sure that this fund succeeded. And so one of the ways we did that is that we share the origination points, which is what a broker in private money or hard money, that's how they make their money. They charge high points, anywhere from 2 to 4 points on a transaction. Well, when we design the fund, we have the house share of the points going into the fund as income.
Okay, so if I'm an investor in the fund, not only am I going to earn interest on
the note rate
interest, but I'm also going to participate in the income that you earned,
that the broker earns. By originating, the loans. So right, and that when I say the house share is that we employ independent loan agents to originate our loans, and the average pay to a loan agent is 50%. It's half the origination fees. So the half goes to the agent, the other half goes to the house. The house share of the points, if the fund is the loan originator, goes to the fund. But let's get back to how easy it is to invest. Or easy to understand, rather.
Yeah, that's good.
A mortgage pool fund is essentially a mutual fund of real estate secured notes. There's only two assets in the Pacific Private Money Fund. It's either cash or it's a loan. It's a promissory note secured by a deed of trust. That's the asset. It's a receivable.
Basically,
it's a high rate of interest.
You're just like the bank.
Right.
I mean, the bank either has cash or it has assets. Those assets are loans that they've made to borrowers.
Right, and the types of loans we're making, which is the other thing that's going to be easy to understand, is some of you out there listening to this, maybe you've heard of mortgage pool funds in the past, or maybe you've invested with a hard money lender in the past, and you might be thinking to yourself, oh yeah, I know that those are the guys that make seconds. And that's not what the industry is today. The private money lending industry today is generally providing first position notes, purchase loans, basically loans to help a real estate investor buy a property that they may intend to remodel and then resell. And we don't do 100% financing either. We're not doing high percentage financing. We're actually doing fairly conservative financing. So the average loan to value of the fund today is 61%.
Okay, so if these borrowers, I'm presuming, because we haven't talked about we did talk about the interest rate. You gave a little bit over around 8.6%.
Right.
So
our note rate to the investors is about anywhere between 9 and 11%.
Okay. Now banks don't generally in today's market lend money out that high.
That's correct.
So the first question is, why are these borrowers paying you 9 to 11%?
Well, we talked about how the banks pulled out of the lending market for real estate investors, and that's really the primary reason is most real estate investors can't get a bank loan. There are such strict new underwriting guidelines that affect the banks today that they've largely stuck to making money where they make money, which is consumer home loans. But that's only the first reason. There's actually two other reasons. The second one is probably the most important one, really, is speed. And in this market, this competitive marketplace, the real estate investor who gets the property under contract is the one that makes the most aggressive offer. And by aggressive offer, it might be, hey, all cash offer, no contingencies, I'll close in 2 weeks. Now, they'll say all cash to the seller, but what they really intend to do is to go to a private lender like Pacific Private Money and get a, easy, simple 70% of the purchase price loan,
Yeah,
and they'll
because
come
they-
in with 30%.
with 30% because they got the cash. I was listening to the afternoon talk radio on the way home yesterday, and this was not a real estate show, but they were bringing up the fact that there was a guy who wanted to buy some real estate, and his FICO score was 770, makes really good income. I mean, everything is falling in line, and guess why he couldn't get a loan?
Why?
Because he had just recently become self-employed. I mean, he was doing so well at his job.
Oh yeah, that's a death knell in a bank loan.
He decided, he goes, you know what, I'm making really good money, but I'd like to be my own boss, and so I want to be self-employed. Well, suddenly now he doesn't get a W-2, he gets a 1099. Bank says, you haven't been in existence long enough, you need to see at least 2 years. So here's a poor guy who wants to buy a piece of property, and he can't do it through regular bank loans, so guess what? He's going to have to come to Pacific Private Money.
Well, we've all heard the war stories around, hey, I was approved by my bank, and then I went and bought a car. Or I went and did something. I got this great offer for a credit card in the mail, and I took it. And their score drops a few points.
Oh my gosh, I've had that. I've had to, not to say grovel, but I've had to go to my bankers and say, wait a minute, you don't understand. The reason that I have this credit card is because they offered me 0% financing for 18 months. It was too good to be true. All I did was just take the money and pay down other debt. I didn't go buy a boat or
you want to make your mortgage broker cry. Tell them, I just signed up for this new credit card when you're in the middle of a home loan application.
Okay, we're going to cut to our first commercial break. Before we do, though, Mark, people are listening in the audience right now, and they're hearing that they can earn over 8% interest, fairly conservative, and we're going to go into how conservative it is in the next segment. How do they get a hold of you?
Well, there's several ways. One is just simply to call our office. You can call over the weekend and leave a message, and I'll call you back next week. We're local. 415-883-2150 is the phone number for Pacific Private Money. Again, 415-883-2150. Or go to our new website that we made specifically for our fund, the Pacific Private Money Fund, and you can get there by going to pacificmoneyfund.com. That's pacificmoneyfund.com. And last but not least, we have a special website just for our radio show where you can listen to this show via podcast anytime you want, or listen to one of our past shows, and that is at mortgageinvesting101.com. The name of the show, of course, mortgageinvesting101.com. Go there, listen to one of our past shows at your convenience, or tell a friend.
Okay, and we're going to cut to
Who used to say that, by the way?
Yeah.
Tell a friend.
I don't remember, but I remember hearing it, but I don't remember who said it.
Figure it out during the break.
Yeah, okay. We're going to cut to our first commercial break, and again, the theme is #1 hits of the 1980s. That's, I guess, sort of our era. Mm-hmm. All right. Who sang Mickey in 1982? Remember? Oh, Mickey, you're so fine. You're so fine. You blow my mind. Hey, Mickey.
Cruel.
Okay.
Now that song's going to be going through my head for the rest of the show.
I think I did that to you a couple of weeks ago, too. All right. And the other part of this was, and recorded an MTV video showing her as a cheerleader. I remember that one.
Yeah.
The first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-529-1134. That's 888-529-1134 to answer this question. Who sang Mickey in 1982 and recorded an MTV video showing her as a cheerleader? 888-529-1134. Make sure to include your name, your email address. Please speak slowly. Spell out your email one letter at a time. Don't touch that dial. Mortgage Investing 101. We'll be right back with Edward Brown and Mark Hahn. Segment number 1.
One down.
1 down.
2 to go. Yeah, this one we decided to do 3 segments instead of 4, because sometimes when you do 4 segments, it goes by so fast. You just start getting into something, and it's like, oh, gotta do another commercial. Because when you have your own show, you can. I mean, we could do no commercials if we wanted.
So, who does the commercial?
We do. We record our own. So this show just has some of Edwards. We have a couple of sponsors, I think, that do theirs. I've got a couple of I've got a 30-second and a 1 minute. So we're flexible. Edward is able to get sponsors that helps defray the cost of the show. So
Means nothing huge. I wish it was.
It's not money making yet.
No. Gotta get syndicated.
That's right.
Fun stuff.
Very good. You never got to your third reason.
I know.
Okay, it's always good.
It's class. I mean, we
Third
more
reason
often
why
than
they're
not.
simple.
More often than not on these
So-
shows, you
so-
can't
so-
get to this. I've got 5 things I want to share with you. We get to 3 and we go off on a tangent.
Yeah. Most of that's my fault.
Let me know when you're going to go back on. But so you're at 8.6 for the trailing 6 months.
yeah.
And
was-
you
that's
figured
the
that out
average of-
already?
we did. I
Because
already made
I'm
the
trying to get-
distribution checks.
I'm trying to
And
Guys in San Francisco can't figure it out yet.
oh, it's our guys, Fairway America. They're pretty much on the ball. They do all the accounting for us and give me the numbers, and then I'm trying to figure out how to calculate it on a compounding basis. I know there's an easy way to do that. But you take the first quarter yield, then the second quarter yield, and then you can kind of extrapolate. If you take the average of that and go 4 quarters where you would leave it in each quarter, you can actually
Oh yeah.
figure out.
Mark, how much is that? Is the average the yield on the note rate versus the fees going back in?
You know what? Actually, quite a bit is the fees. So I don't know what the breakdown is,
Oh,
but the
yeah.
fees are substantial, and it allows me to charge a fairly aggressive management fee and share the profit. So I'm taking 200 basis points management off the top, and then off the bottom we're taking whatever the profit is and splitting it 50-50 between shareholder and fund manager. So I'm giving my points in to make sure I get the yield, and then I'm taking them back out on the bottom. So.
But it's nice though that the interests are aligned. I mean, you can. The thing I like is that you have some fund managers who will say, you know what, man, I'll just pay 8%.
I'll lower the rate but take higher
higher
points.
because he gets it all himself.
8% and 4 points instead of 9% and 3 points,
Exactly.
or 10% and 3 points. So,
See, this way, he could say it almost doesn't matter.
so I actually
I don't know if you
did a
wanna
note for
explain- I don't know if
12.5% no points.
I don't know if you want to get into explaining load or what you just explained.
Oh, we're going to.
Alignment of interest.
Yeah.
But when
we-
you
we
get
do
done
that.
with this, I'd like to somehow to get this recording and
Oh,
give it to my investors with the
Oh,
package.
Go on to Mortgage
All the
Investing 101,
podcasts are
all the
downloadable.
podcasts.
Yeah, you
Yeah.
can just right
okay,
click
but
on it.
it's
and
different
download
if I
it.
send it to them in an email or something or hand it to them on a platform or.
Okay.
They're 45 megabytes in size, so I don't think you can email them, but you can send links or you can certainly
in
put it on a
Dropbox file.
flash
Unless
drive.
unless you do yeah.
I put a link to your podcast download.
Yeah. Okay, right?
By the way, don't know the answer. 5 seconds of silence.
I have to give them 5 seconds of silence because they have to put the pieces together.
Sorry about that.
That's okay. Don't know. You'll know it as soon as I say. Well, I think you'll know it. To me, it's the only one I know that she did. Okay, here we go. Welcome back to Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hahn, president of Pacific Private Money, the fastest growing private mortgage investment firm in Northern California. When we cut to the first commercial break, we asked this trivia question. Again, the theme is number one hits of the 1980s. Who sang Mickey in 1982?
You know, of course, I think everybody remembers the song, and the video was actually one of the first
Yeah,
MTV
it was.
hit videos. But
Yeah.
I can't for the life of me remember who she was.
Tony Basil.
Oh, that's right.
Anyway,
One hit
okay.
wonder.
Yeah, I know. You know what? If she was on, she'd probably say, wait a minute, I had a couple more hits, but that's the only one I remember. Okay, so Mark, I think when we cut out, we realized that you only mentioned 2 out of the 3 main reasons why people come to you.
Right, we were talking about why would someone borrow money at 9, 10, or even 11% when bank loans and bank rates are at less than 5%.
Yeah.
And we talked about the first reason that, for the most part, banks just simply aren't making those loans. If you go to your bank and say, hey, I'm buying this rental property to buy fix and flip, will you make me a loan? No matter how good a borrower
They
you
laugh
are, they're
at you.
basically going to say
Yeah.
no. Well, because it's a short-term loan, they don't like to make short-term loans. Most of the loans we make are short-term loans. So it's really not the type of loan that a bank wants to do in today's market. And then number 2, we talked about speed, in that the real estate investors who are successful in getting a property under contract oftentimes have to make very aggressive offers with no loan contingency and a fast close. And then number 3 is the condition of the property. Oftentimes,
Oh, yes.
you know, they're missing components, missing a kitchen, or it's just. In fact, we did a loan recently where the house was in the midst of being remodeled and they stopped. They ran out of money and it sat there for 6 months or a year, and so someone else picked up the property with the intent to finish it.
And sometimes if it's uninhabitable, the
Right.
bank won't do it. In fact, it's interesting. I actually had Starbucks coffee this morning with my banker, and he was telling me about some loan that they were trying to do, and they said, yeah, they finally got to the third level of approval. And how many now at Pacific Private Money? How many levels of approval do you have?
One. I mean, it's just. I mean, that's really the difference. In fact, I have several repeat borrower clients who tell me that they're just, even though it's so much higher the note rate, it's so much more expensive to borrow money privately. Even though that's the case, they'll never go back to their bank because it's no muss, no fuss. It's really simple. It's fast. Especially with my repeat borrower clients, they pick up the phone, they call me, and I already have all of their background information.
Exactly.
I know what their credit is. I know what their background, done the background check, done it all, and they're repeat, and they've demonstrated to us their ability to perform on a short-term buy, fix, and flip loan. And we're able to close. I mean, we still do all the things we have to do legally in order to do a loan. That's something else that's worth pointing out is that even though we're private money, some people call us hard money still, although I like private money. It's kind of the new term for a new business model today, where we do first position notes, mostly short term to real estate investors, not seconds to consumers in distress. But we use the same type of promissory note and deed of trust that the bank uses. So our loan documents aren't really any different, really, than Wells Fargo or B of A.
You're not taking shortcuts.
No. We go through a title company. We get title insurance. We make sure the borrower has an insurance policy that names the lender, which is the fund in this case, as the mortgagee with additional insured. We don't fund the loan to the title company until the borrower shows up and signs all the loan documents. And there's about 50 pages of loan documents. And it's very much like that. And that's because of the regulations. And again, we use a standard promissory note, a standard deed of trust, and a number of other supporting documents and disclosures as required by a lender law.
I'm guessing also that you don't make your borrowers explain every $100 that went in their checking account deposit.
Well, that's what I mean by no muss, no fuss. We don't really need to delve into the nitty gritty. I do sometimes, depending on the nature of the loan application, I might ask for tax returns, but generally that's not something we really dig into.
You can use your common sense, use some discretion.
There's common sense. Here's the biggest difference in the loans we make from a bank loan. A bank loan, when you're a borrower to a bank, you're nothing more than a set of numbers. You are literally a bunch of ones and zeros. You're a FICO score, you're a DTI ratio, which is debt to income ratio, you're how much cash you have in the bank, you're a number of other, you're an AGI, your adjusted gross income on your tax returns for the last 3 years. You're a set of numbers. You plug all those numbers in, the banker does, or your mortgage loan originator does, and you get a green light or a red light, or move to the next level light for the multi-level approval process. In private money, we're mostly subjective, meaning that if I don't like the tone of your voice when you're talking to me over the phone, I'm not interested in making you a loan. I mean, and that may sound silly, but
it's not a prideful thing. It's a character thing.
It's a character thing. I make a value judgment, a gut judgment, after working 32 years in the real estate industry and working with an awful lot of people in business. You can tell a lot by having a conversation with a potential client.
Well, I got to tell you a really quick funny story. When we were doing hard money loans years ago, this one guy came in and wanted like $50 million. I mean, no, I'm sorry. He wanted a $3 million loan, and he's sitting there. And he takes out a nail, as he's talking to us, he's looking at the ceiling and he's taking out a nail clipper, clipping his fingernails over my desk as he's trying to explain how conservative this loan was. And then when we said, well, are you going to personally guarantee it? Oh, no. And your net worth's $100 million, and you're not going to back up this $3 million, or the property was worth $100 million supposedly, and all he wanted was a $3 million first mortgage. And I said, and you're going to personally guarantee this, aren't you? No. Really? I would jump through hoops if I needed to, to guarantee something like that, because it's like
right. That told you something about that borrower. Yeah. I mean, his behavior told you something.
Exactly.
His reaction to being asked to sign a personal guarantee. We ask all of our borrowers to sign a personal guarantee. Now we have made non-recourse loans, which is what they're called when
Yeah.
there's no personal guarantee. We've made them, but it depends on the circumstances.
Sure.
But generally, if someone comes in and they want to borrow in their corp or their LLC, we'll ask them, will you sign a personal guarantee? And when they say no, I usually dig a little bit deeper. I want to know why.
Yeah.
Why aren't they standing behind that deal? Because again, I'm using monies from people's retirement funds here,
Yeah.
and I am not, I'm
You're not,
looking.
you're not a loan-to-own guy.
No, right, and that is another feature of in private lending. I'm an advocate for, and my primary client is the source of my capital, my lender clients, the investors in my fund. Those are my primary clients, not the borrower. When you, as a borrower, walk in the door of a conventional mortgage loan originator, you become their client. And so for conventional loans, the client is primarily the borrower. But in private loans, the number one client, although I love my borrower clients, I really
understand.
do, but my
Your
primary
investor clients.
responsibility is to my investors.
Okay, I'm gonna put you on the hot seat for a little bit here. In all the years that you've been doing this now, how many loans have gone bad?
We've done over 600 loans at Pacific Private Money, all privately funded. We've had to file a notice of default, which is how you start the foreclosure
Okay, yeah. So
process.
somebody didn't pay on their mortgage for a month or
Right.
two.
Less than 20 times we've had to file a notice of default. Now,
3%.
I
I don't think the banks
most
have that
of the
kind of
time
record.
when you file a notice of default, they figure out a way to reinstate the loan or bring it current or pay
Yeah.
it off. Now, we've only had to foreclose, and when I say we, it would be my lender clients on individual notes. We've only had to foreclose less than 10 times.
Okay, so now we're down to less than 2%.
Right.
Okay, so and of that, how many people lost money?
None. There's never been a loss. Zero loss of capital. And in fact, not only zero loss of capital, they've also, for the most part, usually made money, or they own the real estate. They're happy to own it because they believe they got a good deal.
Well, again, you're not lending at 100% loan to value. You're lending at maximum about 70%.
Right, exactly. And so, another thing to kind of hammer home, which I think is really important. So we're talking about the Pacific Private Money Fund, which is which is akin to, it's not exactly like, but I'm going to describe it like a mutual fund of real estate secured notes. That's the investment product that we use to return what is now year-end 8.57% to our investors. And we believe it has safety and security features and is a conservative investment. And one of the reasons why we believe it's conservative is that we rarely make a loan, first of all, higher than 70% loan to value, meaning that our borrowers coming in with 30% equity, 30% cash. It's either their cash or maybe they have an equity partner's cash. That's number one. But number two is that these guys more often than not are buying the property under market. So when we do a loan for someone who's buying a home in the Bay Area to buy, fix, and flip, and they're paying $200,000 for it, and we're going to make a loan for $140,000, which is 70%. They're going to come in with $60,000. They're going to turn around. First of all, they're probably getting that at an exceptionally good price. A lot of these guys buy via short sale, and that might be on the retail side. It might be a $225 value on the retail end. They're getting it for $200. But not only that, they're going to take their own capital above and beyond the 30% down. They're going to improve that property and put it back on the market.
So your loan to value is actually going to go down.
Right. Our average loan to value exposure on a property we make a loan on, by the time the borrower has finished remodeling, is almost always below 50% loan to value on the improved value.
Okay, now let me go back for a minute here, because you had said that you kind of made it akin to a mutual fund. All right.
Yes.
Now, when I'm familiar with mutual funds, there's two things I think of. One, potentially a load or sales commission going in, and two, liquidity. I want to get out at some point. Can you address those two things?
Sure. So our investment, the Pacific Private Money Fund, is a no-load, no-fee investment. So if you have $100,000 that you want to put to work and earn what we're now paying 8.5% to our shareholders, you would contact us. We would qualify you, and then fill out the paperwork, which is very, very simple. You would make that deposit. we would put it into our subscription account, which is where all deposits go in. And as soon as we have a loan to fund, that money is moved into the operating account and begins earning interest immediately. There's no fee to you. We'll even reimburse you for the wire fee that you sometimes a bank might charge you $25 if you decide to wire your money into our account. Now on the back end, when you request a redemption, which is what it's called when you want to get your money back out of a fund, you request a redemption. It is a little bit different than say a mutual fund. Mutual funds are publicly traded; they're priced daily, and then when you make a redemption the following day, they will at that share price they will redeem your shares in the mutual fund. Our shares are priced monthly, and we do that because it's not cost effective. We're not big enough. We're not hundreds of millions of dollars to where the administrative fees would be a fraction of that. We price our shares monthly to keep the admin costs to a minimum. So if you want to redeem, and we do have a redemption period, we ask that you keep your money in for 2 years. That's important. So after 2 years, 0 redemption fee. You request your money. Let's say it's the middle of the month. Today is the 17th. You're requesting your money. 18th, right? My watch is off. You request your money on the 18th. On the 1st of February, we will then honor the redemption request based on the share price. So it isn't immediately liquid. So we're not looking for people, but we're not looking for people to treat this like a money market account or something that's highly liquid. It's meant to. I mean, this is a serious investment. We've got a serious business model where we're able to return to you exceptionally high yields that you can't find an 8% yield with the safety and security features that we have
not with the
anywhere.
collateral. Not with the collateral
You
you
can't.
have.
I mean, the stock market. I mean, please. I mean, that's an equity play. I mean, you put money in the stock market and you can lose principal. The likelihood that you're going to lose principal in the Pacific Private Money Fund when we're making loans at 70% loan to value on a generally below market price, where they're going to improve it to where we're at a 50-50, 50%.
We'd have to have more of a crash than we did in the 07.
That's absolutely right. I mean, if something were to happen in the economy that caused the real estate market to go down, where the loans in our fund all of a sudden we're looking at loss of principal, we would be talking about an economic calamity of unprecedented proportions.
Now, you said that it's a 2-year lockup period, but if I really need my money after, let's say, 13 months, can I get some money out even with a penalty?
Right. So we wrote the fund so that the fund actually charges a prepayment penalty if you need to take it out within 2 years, and that money doesn't go to me or the broker; it goes to the fund. So again, it's a way to entice people, or at least to prevent people from putting money in and saying, "Oh, I'll keep it in there for 5 years," and then 60 days later they pull it out. So there is a redemption charge. It starts out at 5% for the first 6 months, and then it goes down 1% every succeeding 6 months. So by the time you get to the 18th or the 19th month, it's 2%. So the last 6 months, if you had to pull your money out,
if you would have earned, if things stayed the same, at least 8.5% all that time, so you're actually still way ahead of the game.
Right. Let's just say it was 8%, and then 8% first year and 8% the second year, and you took it out a year and a half and paid a 2 or 3% redemption fee, but you are up 16%. So you still have made a double-digit return.
Or if you're 18 months in, it would have been 8.5 plus another 4.25.
That's 12,
so
right?
12 and 3/4. Okay.
That's right.
And let's put it this way: you're still doing a lot better than if the money was
You're
sitting in
still
the
money
bank.
ahead, so you're not losing all of the gains.
interest. Okay.
That's what's important.
We're going to cut to our second commercial break. When we come back, Mark, we're going to ask you about give us specific examples, and hopefully you have a deal of the week to share with our listeners. Okay, second trivia question. Again, the theme is #1 hits of the 1980s. Music is what we're talking about here. Arthur's theme, The Best That You Can Do. Who sang it? And you got to sing it like this. Remember high voice?
Yeah.
Okay, the first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-529-1134. That's 888-529-1134 to answer this question. Arthur's theme, The Best That You Can Do. Okay, now I'm not going to sing it. Okay, who sang that? Call 888-529-1134. Make sure to include your name and your email address. Speak slowly. Spell out your email one letter at a time. You're listening to Mortgage Investing 101 with Edward Brown and Mark Hunt, and we will be right back.
Christopher Cross.
That's right.
It's like, how fast can you Google? It used to be, how smart were you?
I know. It's so
Did you have to
funny.
Google that one?
Well, I've been Googling them, yeah. But I'm just trying to. I had a brother-in-law that was a trivia nut.
Yeah.
And he prided himself in knowing all this stuff. He must just be bummed because now
No, it doesn't
I
matter.
can just
yeah.
Oh, that's right.
I got that in as fast as I could type in Arthur's theme song.
That's funny.
Boom. And it was like fourth down, Christopher Cross.
Crisscross.
I didn't even have to open the
Crisscross,
page.
yeah.
It just came up on the Google window. And the other one, Tony Basil, I've never even heard of her. I can't remember, but I do remember,
Do you remember the song?
Whatever happened to her?
I know. So I didn't get a chance to see your notes. It was
Oh, yeah. I said equity lender 30% down
Uh-huh.
and emphasize that's based on your investor borrowers are buying
wholesale.
wholesale.
Yeah.
So there's additional safety, and Mark handled that.
So I'll say the answer is crisscross, and you go, wasn't there those two young kids who wore their pants backwards?
Yes. Or actually, no, you can say that. You can say, wait a minute, those guys who wore their pants
Is this
backwards.
the parking structure you were talking about right here?
Yeah.
Okay, yeah, I couldn't find it. I parked like behind Joe's, and
Oh,
it's
yeah.
like 25 cents for like 18 minutes. So I went through a whole pile of quarters to get an hour and 45 minutes.
Dang.
Oh,
They don't have a.
And well, in the last
card.
quarter I put in, it didn't register.
Oh,
So I got to
shit.
leave here about 4:15, go put more money in the meter,
Oh, fourth. Oh, yeah. Well,
or leave and
we're
then
going to be
head
done
to
in.
the
Let's
Corte
see what
Madera.
we got here.
Well, you got that other one though too.
Oh, yeah. We got,
This is fun.
So what loans
So
am
you
I
guys are
got?
doing real well.
Thank you.
I got to think of a deal of the week now.
If I could get a way to put this together for my investors so they can listen to this along with the packages.
Well, we got to do a dog and pony show. In fact,
I don't think we need to. I think they're going to want come up and meet Mark,
Yeah.
meet you guys.
But it's always, I mean, when we did, when I used to do hard money loans with Marco, the guy who sits there, we had a financial planner who used to feed us business. But before he did, the first thing he did was he had, because he was fee only, whatever, he had said, you know what, I like what you're doing, and I'll put a lunch together and have 20 of my best clients there. So we did our dog and pony show, and after like an hour, people started asking questions, and after a half hour, we were done. We had 19 people invest.
Really? Yeah. Well, that's what I was telling Mark on the way up here. We need to do a whale fund, to basically create a line of credit to fund deals and flip.
Well, that's. I mean, I've been doing that.
Yeah.
I
And I
I
got.
told him a little bit about
Oh,
it.
you
though,
told him
you know,
about it, okay.
Yeah, I got a
approximately
guy-
$1 million access to, and then he was saying, "Oh, we need 10 million." Well, it's one step at a time. But no, absolutely, because he and I were talking about how our biggest competitor now, who's basically taken all of my best clients, is Louis Bartis, who used to work for me because because Michael Joseph.
He's got a great.
Michael Joseph found a hedge fund investor whale who put up I don't know what the commitment is. I don't know if it's 100 million or whatever it is, and Michael Joseph told Lewis basically how he wanted the business model to be, specifically target repeat clients and just treat them like kings and make it easy for them.
And he's doing it.
And he's
He's
doing
just
it. And
repeat.
on the way up here, I was talking.
Repeat.
repeat rehabber client. Yeah,
Repeat.
borrowers, yeah.
He's done 20 or 30 loans with Joe Metz, and then Joe gets up. He's got a meetup group, and he's singing Lewis's praises.
Right, and I'm the one
He's
who
saying,
did
"I love
Joe's
Louis Bart." I
first
said, "How do
several loans.
How can I compete? What do I need to do to get your business?" He goes, "I don't think you can." I said, "Why?" He goes, "Because we just love Lewis. The guy's amazing. He takes us to lunch. He takes us to lunch. I call him, say, here's the deal. I need a loan, 70 cents on the dollar. Boom, done. 3 days I have a loan. I just go and sign the docs. No muss, no fuss. I don't have to get an appraisal. I don't have to do a credit report. I don't have to. I said, well, do you fill out a worksheet or something online? He goes, nothing. I talked to him for 5 minutes on the phone.
Just
The next
tell him
thing I know,
what
I
it
got the
is.
money. How can you compete with that? I said, well,
What does he get charged?
thanks for sharing. Let me noodle on that a little bit. 10 and 3. And I think
That's the only way you can compete.
I think on whales, on larger loans, he's going 2, and he might go 9.
Yeah, that's
But he's got a constraint because his investors are getting 8. I figured out a way to get the keep the return up there at 8, 9, 10% to the investors.
Yeah.
And it's with an AB bond deal. where we.
Yes, that's we were.
And I've already got
talking
all the
about that.
paperwork, all the legal done.
Oh,
I'm
okay.
putting that into our
Perfect.
deal.
I mean, you give some of these people 6% where they're at 30% loan to value, right?
Yeah.
Something like that. Or I don't know if you have to go quite low.
We can talk about it another time. There's plenty of time to talk about it. We're going to strategize. That's when we're going to do the dog and pony show. I get this guy that's going to put up $5 million and then have host a luncheon at the Lafayette Country Club with
Perfect.
all of his $5 million plus guys.
Yes.
He's a
Perfect.
former senior vice president with Deutsche Bank Berkshire. He's done about $5 billion in loans
Okay.
in his career. He's 10 times Michael Joseph.
Yeah.
And I've known him for 30 years. I was a big multifamily guy. I was one of his big clients.
So
He owes me.
So then one of those things you need to do.
He
is
said,
get
so
the loan,
he
is
was
get
one of
the
my first
borrowers.
investors 3 years ago, and SCI screwed the boarding up and couldn't get his check to him. And he said, look, I don't have time for this bullshit. Call me after you've done 100 loans.
You know, I got to say that, for
That's when we do that.
good personalities, Michael Joseph is doing the right thing because then you don't have to go chasing new borrowers.
Well, they are, and look,
Well, no.
it didn't work. Michael Joseph didn't work for me because he came in and said, I'll be your 50-50 partner. And that didn't make any sense for me to cut my profit in half. But for Lewis, he was getting 50, he was already getting paid half of the origination fee. So now he goes, I'll just go off and have my own company with this guy and I'll make even more money.
Sure.
So, I mean, you can't blame the guy for
Not for that part.
I wish he would steal all my clients, but what are you going to do?
No offense, he's a smart guy. But see, what I do is I study smart guys.
Yeah, there you
And
go.
I'm learning from Lewis, and we're going to now take it back.
I listened to a tape on that from one of my favorite coaches, Dan Sullivan. He was all about. He calls it humanity IQ, leveraging other people's talents, experiences.
But you got to do it
attitudes.
ethically, though.
Ethically.
Oh, yeah. Well,
Yeah,
that's
dude,
the big
that's-
difference between me and the person we're talking about.
Well, in this case, you've taken them back.
And I really do believe if you do the right thing,
It's
it comes back.
Yeah.
It works out in the long run.
exactly. That's why he's been successful. Okay, ready? Yep. Here we go. So you'll answer the question: are those two guys ever?
Crisscross.
Yeah. Okay, here we go. All right, here we go. Welcome back to Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hunt, president of Pacific Private Money, California's fastest growing private investment firm, mortgage investment firm. And by the way, you can reach Mark at Pacific Private Money at 415-883-2150 or go to mortgageinvesting101.com or pacificprivatemoney.com. When we get to the second commercial break, we ask this trivia question. Again, the theme is #1 music hits of the 1980s. Arthur's theme, The Best That You Can Do. Who sang it?
Wasn't those two young kids who wore their pants backwards crisscross?
Close.
Christopher.
It was
Cross.
one guy, Christopher Cross. Such a funny
Christopher
guy.
Cross, that's right.
Okay, so Mark, we promised the audience we'd come back with the deal of the week. And if you don't have a specific deal of the week, give us a specific example.
Well, I do actually have a deal of the week,
Okay.
which is kind of interesting. And here's an example of a loan a bank would never do in 100 years. So I get a call from a commercial real estate appraiser that I've actually known for about 10 years because he appraised some property for me way back when. And he says, I am exercising an option to purchase, and let's see, what was it? It's a, how many units? It's an apartment building in Oakland. I'm just trying to remember how many units it was. I apologize here for the brain stump here. I think it's like 12 units. And I go look at the property, and he's just done, a great job of remodeling it. And so it's in great shape. It's 100% occupied. It's not new inside. It's 12 units. It's in Oakland. His rents are a little bit below market, which is always good for an upside. But he's got an option to purchase it. He got into this option 5 years ago, and he's been paying monthly. The option price has been going down every month as he's been making a rather large payment to the seller of the property, or not the seller,
So
the
the
owner of
option-
the property who gave him the lease option.
Okay, so the payments are going towards the sale price.
Right. So in other words, this borrower has the opportunity to exercise a lease option on a property, on an apartment building that he has leased for the last 5 years. Now, his option price, which they call the strike price in some agreements, is now based on all the pay downs that he's made and the improvements of the property, which he's gotten credits for, is just over $600,000, $630,000 to be exact.
If he hadn't made any payments, how much would the price be?
Well, here's the answer to that. We had the property appraised, and the appraisal came out at 1.1 million.
Okay.
And I had that appraisal corroborated by a local expert who sells apartment buildings in the Oakland market and who actually has a listing down the street. And he said, "Oh yeah, all day long that property is worth 1.1 to 1.2 million." So here's the rub.
What's the story? Go ahead.
The borrower is asked for a $630,000 loan to exercise a $630,000 option price on a property that is worth
1.1.
1.1 million.
Okay, so from the bank's perspective, it's over 100% financing.
It is 100%. It's a 100% finance
Interesting.
deal on the
Yeah.
acquisition. Is this a good deal for a lender?
Absolutely.
I think it's a fabulous deal. It's below 60% effective loan to value. I personally visited the property. It's a fabulous, strong rental market in this particular neighborhood. The property is in great shape. These guys own and operate already 100 units of apartments. The borrower and his brother have been for over 25 years real estate investors. They're also real estate professionals.
Well, you know what the interesting thing about this too is that the guy really has real skin in the game already.
Yeah, so that's exactly right. So a bank in 100 years would never make this loan. No bank, not a single bank in the entire state of California.
You know what?
would make
They're
this
not,
loan.
and here's the funny thing. I don't even think they're allowed to,
Right,
based on
that's
the rules. Even if they wanted to, legally, I'm not sure about this, but I don't think they're allowed to.
But we look at things like the rental income, the debt service coverage ratio, all of that. These guys have stellar credit. They've put up their tax returns. So we've underwritten this loan very carefully. But the bottom line is that if anything ever went wrong and we took back this property, it's $1 million property. No
Yeah.
exposure, $630,000. So there's an example. Now the note rate on this. I wanted to get their business because I'm not the only private lender in town, so we offered a 9.5% note rate,
Okay.
2.5 points,
All right.
and it's a 2-year loan. Fabulous lending
Good
opportunity.
terms.
I would do this 100 times, and it's a good example of why the private money lending industry is alive and well today, and why our fund, the Pacific Private Money Fund, has opportunities to take advantage of lending opportunities that make sense. This is an example. We talked about the last segment. There's a lot of subjectivity here. I know the borrower. I know he's a professional, and he is well respected in the industry. One of the letters, the broker price opinion letters that I got supporting the appraisal, came back and said, "I happen to know this borrower who I'm not going to name. It was a little embarrassing, but I've known this borrower for a long time, and they've got a great reputation in the industry." So all of the signs, all of the lights are green.
And so if you do that loan, are you going to go to bed at night hoping that he doesn't pay you?
Well, that's exactly right. I mean, the fund would benefit tremendously from an opportunity to foreclose on a
Yeah.
property, but it'll never happen. It'll absolutely
No,
never happen.
he'll be able to find another
Yeah.
hard money lender.
No matter
or
what
somebody.
would happen to him if he stopped making payments and I filed foreclosure, he could fire sale this property in 5 minutes.
Yeah.
So anyway,
Exactly.
so that's our deal of the week, and that's not our typical deal. Again, our typical deal is a purchase financing for someone buying property that can be improved and sold at a profit, and we're typically making a 70% up to 70% purchase.
Well,
on
give us an example of one of the loans that's already in the fund.
Well, we make a lot of loans in Oakland, and one of the reasons is Oakland has the single highest number of single-family homes of any city in the Bay Area. There's thousands of
and the
homes.
thing is that San Francisco has gotten so expensive, people have to go to the outlying areas.
Right. Well, we've made some loans recently in San Francisco as well, but if I had to, if you asked me what city in the Bay Area do you make the most loans in, I mean, by far and away, it's Oakland, and there's neighborhoods and pockets of Oakland that are just fabulous neighborhoods where if you take a home that was built in the 1940s that is badly in need of remodel, everything needs to be updated. We're making loans to guys that know how to go into these neighborhoods, into a neighborhood where there's a strong demand on the buyer side.
So it's not like gang related, because everyone, you think of Oakland and automatically. you think
There are
gang
neighborhoods
related.
in Oakland that we're not fans of. There are
Okay.
some neighborhoods they call, in the flats or the avenues down by the Coliseum is one area that you have to be careful because there are some neighborhoods where if I don't want to drive through the neighborhood, I'm probably not going to want to make a loan there.
Sure. Fair enough.
So again, this is not being this is not discriminating, but it's being discriminate. It's not discriminatory,
Yeah, I know what you mean.
but it's being discriminating in the type and style of loans we do. So
Yeah,
and
using a
again-
lot of discretion on that.
Right, and it's the discretion. Right, we're able to use our discretion. Thank you, and make loans where we feel that this is a good bet. It's funny when I first got into the lending business because again I spent over 20 years in the development side as a principal. One of my first investors used to say to me when I would send him a lending opportunity, he'd go, "Would you put your mother's money in this?"
It's a good test.
And I love that because again, I've used that over and over again when I'm training my new agents. Don't just send me something you got from some other broker over the phone that you hope that I'll fund it so you can get paid a commission.
Exactly.
So you need
Check
to
it
really
out.
look at this. Would you put your mother's money in it? So we need to act with discretion on the type of loans we make. So anyway, a typical loan in Oakland right now in the markets where we're lending is an acquisition of around $250,000 to $300,000 because again we're lending in the higher end markets, not the lower end. Part of that's because we just don't like making small loans.
Sure.
Our
You have to do the same amount of work for a $50,000 loan.
yeah,
as
we
a
don't
$500,000.
technically have a minimum loan amount, but when it's below 150, I'm not real thrilled to put my staff through the rigmarole because again the fee income is just not all that great. But
Sure.
we do, we'll take a look at just about any transaction that comes in. But again, the typical loan would be $250,000 to $300,000 on the acquisition side. It needs anywhere from $50,000 to $100,000 remodel, and that really depends on. Are they just going to do the kitchen and bath and then the paint and flooring, or are they going to take it all the way down on the inside, down to the studs? And oftentimes, sometimes they will do that. They'll change out the electrical, the plumbing, do all new sheetrock, maybe move some walls around to make the rooms bigger, and you'll have a turnkey like new home in an established neighborhood. And I'll tell you again, the days on market for a properly remodeled home in the
31.
middle class neighborhoods of Oakland is all below 30 days.
Wow.
Oh yeah.
And so again, how do people get a hold of you? Let's say I'm listening to the show and I'm thinking, this sounds kind of interesting. I'd like to earn 8+% on my IRA or a regular savings account.
So
How do I get a hold of you?
So again, I'm Mark Hanf. I'm president and broker for Pacific Private Money. We specialize in making conservative loans to the real estate investment community, and we use our funding vehicle, the Pacific Private Money Fund, to make those loans. And that vehicle, the Pacific Private Money Fund, is paying yields between 8 and 9% right now. About 8.6% is what it paid out in the fourth quarter. And so with safety and security features that you're just not going to find in stocks or other types of investments. It is considered an alternative investment strategy. You're probably not going to hear about this from your financial advisor. They're not paid. They don't earn to sell this type of thing because it's not publicly traded like stocks or bonds. But it is growing in popularity. A lot of people who have self-directed IRAs, for example, are opening self-directed IRAs for the specific purpose of making high-yield alternative investments
That's
in
what I
real
want to
estate
ask
secured
you
notes.
about this. So I invest my IRA, but I don't want to touch my IRA. Can I reinvest the dividend distributions?
Absolutely, that's one of the benefits of the fund is you may reinvest. In other words, buy more shares at the end of every quarter when we make the distribution.
So actually, my compound interest is more because you're paying quarterly, I understand.
Right now, the compound interest rate, if on a compounded basis, we're at about 8.9 right now. And again, past performance is not a promise of future results, but we think that the types of loans that we're going to continue to make in 2014, and we don't see the demand changing for our capital. So we still believe that we're going to deliver, as we've been promoting in our fund, 8 to 9%. But let me finish. I didn't actually tell the people how to get a hold of me. So if you're listening, going, how do I get a hold of you? I gotta park my car and go to where I'm going. So it's Pacific Private Money. You go to our website, pacificprivatemoney.com. That's pacificprivatemoney.com. Our other website specifically for our fund is pacificmoneyfund.com. So we do have two websites, Pacific Money Fund or Pacific Private Money. Sorry if that sounds a little bit confusing. If it is, just call us at 415-883-2150. That's 415-883-2150. If you're punching that in your phone right now and you want to call, leave a message, do so. I get a whole bunch of messages when I go into my office on Monday morning and from people listening to the show who left their name and phone number, and I'll call you back and send you some information.
You know, one of the things I really appreciate about it is the fact that if for some reason you don't produce the results that I really want, I can get out with no fee.
Absolutely.
It's similar to a mutual
right.
fund.
With it, after 2 years.
After 2 years, I understand.
Yeah.
That's fair enough. Okay, tune in next week to Mortgage Investing 101. We'll be giving away more free vacations for answering trivia questions and giving more valuable information about mortgage investing. Thanks for listening. I'm your host, Edward Brown. And on behalf of Mortgage Investing 101, so long. We'll catch you next week. 10 seconds to spare.
Right. Nice.
And
Thanks for that.
And that's a show.